All right, everyone, welcome to another episode of Coffee with Connections. And we've got a special guest today, Dr. Daniel Crosby, who is a psychologist and behavioral finance expert. Good morning. How are you?
I'm awesome. Thanks for having me.
Now, you're certainly welcome to be here. Now, tell me, I recently just read The Laws of Wealth and a Zoom screen there. First of all, phenomenal book. I mean, I thought it was one of the most I don't know. I've never quite read an investing book like it. I would say it really felt like it was a behind the scenes point of view of what makes humans tick when it comes to investing and wealth and the stock market and security selection and whatnot. But my question is, how long, like, all the immense examples and research and whatnot you cited in there, how long did that take you to compile and then formulate your own thoughts around it?
So it's interesting. So I'll digress a bit here. So there's this famous story about Picasso sitting in a park, and this woman comes up and she's like, "Hey, I'm a huge fan. Draw a picture for me." And he draws a picture of her. It takes like 5 minutes. And then, she says, "What do I owe you?" And he says, whatever, $1,000 or whatever,
Hmm.
some big number. And she says, $1,000, like it took you 5 minutes. And he says, "No, ma'am, it took me my whole life." So in one respect, it took me about 3 or 4 months to write The Laws of Wealth, but that's like after it was fully outlined and sort of the ideas were fully fleshed out in my head. It took me 3 or 4 months to like put it down on paper.
Hmm.
But years. It took me years to
Right.
sort of figure this out. And I wrote a book after that called The Behavioral Investor, and I'm excited to write my next book, but I'm
Hmm.
still compiling, all these years later, I'm still
Hmm.
compiling, notes for my next book. So 3 or 4 months to write, a lifetime to think up.
No, that makes perfect sense. Well, and we'll dive back into some of the details because, I mean, as a financial advisor, I've found The Laws of Wealth just immensely beneficial for my own sake. But then if you were just a novice investor, I think it's an incredible book to read to inform yourself. And we'll jump back into it. But I want to ask you, when you, because your position, and I would say, and you would maybe, I'd like to hear your thoughts on it. It's almost like there are very few people, I think, that in your position, because you, in one hat, you're a clinical psychologist, correct? And correct me if I'm wrong with that terminology, but then also an advisor and also a behavioral finance expert. Now, when you grew up and you dreamed of a career, was one of those or both of them kind of your goal? Or how did you evolve, I guess, from in being this dynamic type of work and employment and passion?
Yeah, I wanted to be the catcher for the St. Louis Cardinals, but Yadier Molina has been holding that job down admirably for over a decade now,
Mhm.
and I can't really hit a curveball. So no, I wanted to be a baseball player when I grew up, but
Yeah.
my dad is a money manager. My dad is a
Okay.
financial advisor,
Okay.
and so I grew up in a home where, I think unlike most American homes, we talked about investing around the dinner table. We
Right.
talked about saving, and I joke it's not a joke, but debt was a four-letter word in my house. I grew up in a conservative religious household, and
Mhm.
we couldn't swear, and we literally were not allowed to say the word debt because my dad hated it so much. And so I had that foundation when I went to school. I went on a mission for my church. So I was gone. I lived in Southeast Asia for 2 years and was,
Okay.
teaching English and building schools and all this. And then when I came back, I had, I think, an interest in culture. Having lived abroad for 2 years, I had an interest in doing good in the world. And I
Mhm.
thought that psychology, being a clinical psychologist would be the best way to do that.
Mhm.
Um, Turns out it's very hard work. I was really taking work home with me. I was very stressed out by that
Yeah.
work, and it was just heavy. Like it's important work. I love the people who do that work, but it was very heavy for me.
Mhm.
And so I wanted to apply, thinking deeply about why people act the way they do with something non-clinical. And long story short, sort of that initial seed had taken hold at that point, and I found my way into this industry.
Wow. Yeah. I mean, and I think, the common or a big takeaway I got is that, so much of us as a financial advisor, we know that people get weird when you're talking about money, right? It's one of those
Mm.
things where it's like a lot of ego and pride is kind of wrapped up into about money. So when you and trying to talk to people about money, A lot of advisors, I don't think maybe appreciate enough of how it's not necessarily that they're not trying to work with you from like a business perspective. It's just a deeply personal thing that a lot of people carry a lot of different like baggage and feelings from it, and wrapped up into their thought process. So I think it's just fascinating that you take that, or through your discipline of the psychology aspect, you kind of can understand a little bit where more people are coming from in that regard.
Yeah, it's fascinating. One of the things I looked at for the behavioral investor, my newer book, is that I looked at fMRI studies, so like brain scan studies of folks, and they put people on this brain scan technology, and then they would show them different pictures, right? So they would show them like suggestive pictures, for like activate lust, and they would show them pictures of death and, like dead birds and stuff. And then they would show them pictures of money and like other things that had sort of a strong emotional valence to them. Money had the strongest emotional valence, more than sex, more than death, more than religion, like all these things that we think of as being sort of hot button items. Nothing gets us as sort of cranked up as money does. And because of that, we all grew up in different households, right? We all grew up with different sort of biases and quirks around money. And so, it's a really tricky subject and a touchy subject that doesn't have to be as touchy as it is, I think, candidly.
Right. And then another concept you speak about is people are drawn, because it's such an important thing to us, and it does elicit that emotional reaction. A lot of the times when people just even hear the word or see it or think about it, we're drawn to the sensationalism of the financial press. That's something you spoke about, like whether that's CNBC or even just social media, and just maybe following a very like bold and brash analyst that has a prediction, or they're saying something about the economy. And just to read some of the quotes, is that those who have knowledge don't predict, and those who predict don't have knowledge. Another nice quote I liked was, it's frightening to think about, or you might not know everything, but more frightening, by and large, the world is run by people who think they know what's going on. So my question is that in a world where it feels like all of this information is just coming at us, the news, social media, we can get it anywhere. How would you say, or how do you personally prevent yourself from, I guess, being sucked into it, or letting that like get wrapped up into it? Or for just the average person, is there like okay, look, I'm going to expose myself maybe on a limited basis to this type of stuff, and not let that filter in my decision-making process?
Yeah, so I think one of my disadvantages, and our disadvantages, yours and mine, for that matter, is that I am required to have an opinion, right? Like I'm going to be on podcasts or do media appearances or whatever, and people are going to ask me about, whatever the investing fad du jour is, and what I think about XYZ political thing. And it's actually to my detriment as an investor. The best thing an investor can do is set aside money every month, invest in risk assets, work with a professional, and like go do stuff that matters more. Like, I mean, go play with their grandkids, watch baseball. Like, I mean, a million things, right? Like, it just doesn't matter. Like, there's actually an inverse relationship. I, talked about this in one of my books. There's an inverse relationship between how closely people monitor the financial news and how well they do. There's an inverse relationship between how often people check their accounts and how well they do. So it's like, it's one of these things. It's designed to be sensational. It's designed to worry you, and it actively loses you money. So like, why would you bother? So when I get my financial statements, when I get my quarterly financial statements, I rip them up like on purpose. I don't look, because there's nothing, whether it's good or bad, there's nothing in there that I need to act on. I'm youngish. I have many years left to invest, and it doesn't matter. So I try and ignore it to the extent possible.
I think another line that comes up to me, it's, when financial advisors, I think, are sometimes guilty of like getting on the pedestal and preaching, like, don't make emotional decisions, don't make emotional decisions. And then a lot of them, you'd say, okay, well, then what is your process for evaluating risk and securities and whatnot? I think it was important that you pointed out that it's not that you it's not that we as financial advisors or individual investors are just suppressing all emotions. It's just recognizing it and having a system that maybe negates it or combats it or checks it and somehow puts you in type of a way where you're not making rash, just quick decisions. But I think it's just miscommunicated often, where it's like, don't like ignore your emotions, suppress your emotions. Like, that's not what it is. I think it's more important to say, okay, yeah, you're going to have emotion. Here's the blueprint to navigate in light of that.
Yeah. Yeah, it's interesting because when you look at the research, it shows that basically if we didn't feel emotion, we wouldn't be able to make any decisions.
Right.
So people who have the emotional, lesions on the emotional sort of decision makers, making centers of their brain, they actually can't pick which ice cream flavor they want. Like, they can't pick which shirt color they want, because even low stakes decisions have a strong emotional valence to them that I think we are largely unaware of. And so emotion is going to be there. But what you can do, though, is work with your advisor to pre-commit to not make decisions in a place of heightened emotion. So, like one of the chapters in the laws of wealth are really designed. I don't ever outline this explicitly in the book, but the reason I wrote that book, that's really a set of like commandments, if you will, that should be sort of a deal between a financial advisor and her clients. It's to say, and one of the chapters is, if you're excited, it's probably a bad idea. And that's true. And it's also true if you're fearful, it's probably a bad idea. So you can't avoid emotion, but you can keep yourself from making decisions at a point of an emotional extreme. The addiction literature, like the 12-step programs, they have an acronym called HALT. So it stands for hungry, angry, lonely, or tired. Okay. And they say, you should never make a decision when you're you should halt when you're hungry, angry, lonely, or tired. And the same thing is true of financial decision making. If you find yourself very cranked up about an idea or very fearful about an idea, it's probably not great.
Wow. I mean, I like that a lot. So those HALT, that makes sense. Yeah. Now, and talk to me about, your thoughts, where it's like, if you, a financial advisor, I love the questions that you would say, like, this is what to ask your financial advisor. And one of the things in particular was, if it feels like their response to their like investment approach is long-winded, rambling, and trying to be overly nuanced, then statistically, or I don't know if it's statistically, but that is more likely to be like reflection of like an untrue statement, or maybe just over the top or hot air. That you should be able to boil to, like, the real knowledge is, right, is understanding something complex, but then being able to portray it simply and communicate it simply. How do you find, or most advisors, because a lot of the financial advisors that I'm connected with are thinking about this, is there a piece of advice you would say to advisors? Is it not to boil down your services into like the cliche elevator pitch, but is there, like, when you speak with advisors, what is it that you often like try to have them communicate, I guess, about their process, hopefully, if they have one, but how do you frame that, I guess, when you're talking out with the world?
Yeah, so I mean, you make a great point there, and I say basically, this was my wife's favorite part of the book, right? So my wife doesn't work in finance, and she read the book, I think, to just kind of be nice to me. And so I said, look, what is the favorite part? What was your favorite part? And she was like, oh, the checklist for choosing a good advisor. Right. And I'm like, really? Like, like there's all this, there's all this complexity and there's all this good stuff, if I do say so, in the book. And I'm like, that little 10-part checklist was your favorite. And she's like, look, if you got hit by a bus, like, and I had to like figure out who to have manage our money, like that was reassuring to me. And so the thought there is a couple fold, right? So the first of all, if you ask an advisor, like, tell me about your process for managing money, right? You're measuring a couple of things. First of all, you're measuring their ability to educate, right? Okay, they're going to teach you, because part of their role is to educate you about how capital markets work and what you should be doing. So that's one thing you're measuring. The other thing you're measuring is if they have a process at all, right? because candidly, some folks don't. And there's lots of ways to skin that cat. Like, value investing has worked, like momentum investing can work, like active can work, passive can work, lots of things can work. but you need to have a philosophy, and it needs to be sort of undergird by something that folks can believe in. So basically what you're doing is, seeing if they're good educators, seeing if they've thought it through, and then seeing, allowing you to kind of check it. In markets, complexity tends to be the enemy of good returns. Like, Morningstar did a sort of a return attribution study a few years back, and the best predictor of equity fund returns was price. It's like, so I mean, if your advisor says, hey, look, I take your money, I try and not ding you on fees and spread it around, like that's pretty good. Like, I mean, that's like a pretty, that's a pretty good approach. So you're measuring a couple of things when you ask that one question.
Mm-hmm. Yeah. Now, not to get into the weeds, but some of the financial advisors would appreciate this. And it's, I think it's, you outlined a lot of advisors or individual investors fall camp to just kind of this active versus passive like camp, and almost just like picking a side and then kind of defending it like it's like, oh, like I'm passive, like it's, of course, like, are you kidding? It's passive investing. That's what we do. And then on the active side, it's like, oh, well, no, because I'm passive, you're just buying an index. We kind of pride ourselves on the active management side of it. And I love what you pointed out. It was very shocking in your level of analysis that the S&P 500 doesn't actually seem that passive when you consider how different companies are placed into it, essentially by a committee that's it's really unclear the metrics in which they do it. And they're actively picking in. I don't remember the exact details, but over time they've shown to maybe pull in just like not hot companies, but companies that have an interest or are actually oversold to a degree, and then you end up getting an oversold group of companies where that's like the worst time to buy it because they've become large and overpriced. I thought that aspect and that analysis was fascinating, that I don't think a lot of people dig that deep enough to truly understand passive versus active.
Well, my goal with writing those portions of the book was to just make everyone angry. Like, so no matter no matter if you're, the most hardcore active enthusiast, the things that I'm suggesting in the book are going to be a little more measured than probably you think. And if you're a hardcore passive enthusiast, the things I'm suggesting are heretical because I'm suggesting that active management can add some value. So yeah, one of the things is that the S&P 500 is not like, mined from the earth in its perfect form. Like, it's put together, right. Like, it's put together by a group of people with hangups and foibles, just like the two of us. And they do dumb stuff. And like, one of the things that they do is that they have tended to capitulate to public demand for hot stocks that are on average overpriced and kind of frothy. So right. They did this with the .com bubble. They broke their own rules against adding unprofitable companies to add some of those tech names that got creamed. I'm not saying it's good or bad compliance, don't yell at me, but they recently added Tesla, which was Tesla trades for Tesla trades for more than its next 12 nearest competitors, despite the fact that they make 121 times fewer cars. Right. So like, will Tesla continue to go to the moon? Will they grow into that valuation? Maybe, like, I don't know, but like, right. You'd be hard pressed to argue that today Tesla isn't a little expensive, by traditional metrics, but they put it in because people love it.
Right, they like trading it, and it's a sexy headline.
Yeah,
and just like, we're both the uber cautious, the SEC and FINRA. We're not making investment recommendations, of course. Here, please consult a professional for security selection and financial planning. Let me switch gears. Let me get your thoughts on how closely do you follow, or did you follow, this whole the GameStop situation, where you essentially had like an underground group of folks on the internet, Reddit and specifically, run up a stock that they felt like was, being pushed, being shorted by the quote unquote hedge fund, and almost representative of like old money, institutional money, a different class of investments. And then you had this, crazy market phenomena where, the price was driven way up. And I think now I don't follow it as closely. Do you, from a behavioral standpoint, because the market side of it, and a lot of people were angry that certain trading platforms limited trading. It's like, okay, well, who were they trying to kind of help more in that favor by limiting trading? That's a whole nother discussion that gets into some in the weeds SEC type stuff. But from a behavioral aspect, do you think, I'm going to just stop there. Like, where are your thoughts on that in general, and why do you think, I guess, that occurred from a human level?
Yeah, so I followed it very closely. I barely slept a wink that like week, the week when it was most insane. It was like my Super Bowl. I mean, I was just up
Right.
following it. I was up like into the wee hours of the morning reading Reddit forums and stuff. So I followed it super closely. And, I think there's a couple of things that contribute. First of all, some of this stuff is just old behavior, right? There have been investment clubs and like, investment groups for as long as there's been investments.
Mm-hmm.
So in some respects, the internet is facilitating things, but like, there have been Yahoo investment forums for whatever, 20 something years. And you've never seen anything quite like that. I think it was exacerbated by a couple of things. I think it was exacerbated by the pandemic, right? So you've got a bunch of people stuck at home whose lives have been totally de-risked, right? They're looking, they wear a mask everywhere they go. They can't be with their friends. They're bored. They're lonely,
Mm-hmm.
right? And so they're looking, their lives have been de-risked and they're looking to take risks somewhere.
Mm-hmm.
We also know that people are super lonely, right? Like the isolation from the pandemic has been one of the hardest things about it from sort of a psychological perspective. We're also isolated. And the GameStop thing gave the sense of acting as a collective. Like if you looked at all the memes and stuff around it, it was like a union
Right, like to the moon,
line.
like
Yeah, like yeah, but it was like a union
like
picket line or something. Like no one break, no one break ranks.
right.
Like lock arms and here we go. And then the last two things, it was a message that was so appealing because it promised two things. It promised you great wealth, right? Or that was the
Right.
the subtext of it, right? So you're promised great wealth while doing good in the world. Like you're sticking it to the man,
Right.
and you're going to get rich doing it. And so there was this real sort of Robin Hood, no pun intended, vibe to the to the whole thing. And so it was a super compelling narrative that found its sweet spot at a time when people were bored and lonely and isolated and looking to take risk because every other risk had been taken off the table.
Yeah. Yeah, it was fascinating on a lot of different levels. It's hard to say whether something like that will happen again. It did feel like it was a moment in time where a lot of these macro conditions kind of like were just aligned in the right moment for something like that to almost come out from society. How closely do you follow cryptocurrency and Bitcoin and the impact of that on like traditional capital markets? I mean, you're slowly starting to see more institutional firms, come into the space, kind of embrace it. I think Jamie Dimon, like 2 years ago, like very dismissively said it was nothing that he would ever consider doing, and then they played the clip to him. I saw it recently, a couple of months ago in an interview, like, hey, now what do you think about it? You're seeing companies put holdings in it. Like, how closely do you follow cryptocurrency, and do you feel like in the next couple of years we'll see that more in ETF models and normal asset allocation?
Yeah. So again, without giving advice, I'll say a couple of things. So first of all, Canada has approved a Bitcoin ETF, and the U.S., believe it or not, tends to lag Canada from sort of a financial innovation regulatory standpoint by about 6 months. And so upwards of 10 asset managers have now filed Bitcoin ETF, applications. I think they're all going to get approved. I think it won't be long. I think I think in less than a year, there will probably be a lot of Bitcoin ETFs to choose from. And I think that they'll, I think that they'll be popular. The thing I wrote in the Behavioral Investor about how psychology is the thing that underpins every part of the financial system, right? The little green pieces of paper that we spend our lives working for are valuable because we all agree that they're valuable. Like they're not there's nothing intrinsic to a dollar bill that makes it valuable except for our shared trust. And so in that same respect, the more people believe in Bitcoin, the more legit it gets, there's nothing that underlies it intrinsically that makes it
Mhm.
value besides the trust of the people who are spending it. Now that sounds like a diss. It's really not. I mean, you could say the same thing about just money. And
Right.
so I think, there's something that Nassim Taleb has talked about a lot called the Lindy effect, which is the longer something's around, the longer it's likely to be around. So like,
Mhm.
a book like the Iliad or the Odyssey, it's been around forever. It's likely to be around, it's been around for hundreds of years. It's likely to be around 100 years from now. And the truth about Bitcoin is the longer it can stick around, the
Mhm.
longer it's likely to stick around, because I think it's already outperformed. I think it's already exceeded the expectations of what some people thought. I think the biggest risk with Bitcoin is regulatory risk.
Right.
I think the U.S. government could come in and try and make some noise about Bitcoin.
Right.
And a lot of the biggest mining operations in the world, the Bitcoin mining operations, are in China. So
Right.
I think that there's some political risk there, but I also think that psychology is central to understanding every facet of Bitcoin.
Yeah, and I actually just saw is Peter Thiel, the one of the co-founders of PayPal and Palantir and whatnot, actually just was kind of expressing that view that because of so much of the mining of it is in China, at what point do we consider it, like a geopolitical risk and basically financial warfare type tool? Not that maybe it was designed for that, but just how it's equivalently kind of become positioned. I always thought, I was a believer, at least a couple of years ago, that it would be very tough for a government to fully embrace something that like essentially cuts them out of the process. Like if I can pay someone clear across the world and we can exchange economic value and there's no way for a middleman to tax me, regulate it, and control it. Governments, in nutshells, don't like that, right? It subverts a lot of the power of taxes and purchasing and whatnot, and for their own currency. I don't know. It's a fascinating space, and it's like I said, certainly it's not in no investment advice or whatnot, but it's fascinating. I do think it'll continue to potentially disrupt the entire financial services, banking and whatnot for time to come.
Yeah, the thing about it is, I think some of the biggest promise for Bitcoin is for people in places with crazy inflation, or people who live in countries with like crazy inflation, or people who live in countries without stable economies, or people who live in sort of totalitarian regimes. I mean, there's a lot of places where you could be extremely wealthy, and some jackbooted gentlemen are going to kick down your door and take your money and give it
Right.
to the government. So I think for people who live in developing countries with developing economies, Bitcoin has an enormous amount of promise. But in a place like the West, or in a place like the US, which has a developed economy, Uncle Sam is going to be very angry about being
Right.
cut out of the process, like you said. So great risk, great promise.
Mhm. Yeah, and even just broadly, the cryptocurrency in general, right? Ethereum and all the different altcoins, like the power of, like you said, of empowering folks that maybe are in a situation where they're not extremely reliant on their native currency or source of wealth generation. If they can make money and they have skills and they can use the internet to create wealth for themselves, it's going to be hard to tell them not to do that. It's going to be hard to stop them from doing it. Um, let me ask you one last question, because at Centurion. We work with entrepreneurs, executives, and newly independent or divorced women, or widows and whatnot. That's kind of our three lanes of working with financial planning. But specifically to female versus male, have you had any profound research on the way male versus females identify risk or tend to invest their money? Have you ever looked into that, I guess, extensively?
Yeah, I have actually. So, let me speak to it from the behavioral standpoint first. Like, shout out to the women, because they do everything better. Like,
Mhm.
women are better investors than men, as professionals, as retail, like sort of mom and pop investors. Women are
Mhm.
better than men. Professional women investors are on average better than men. Um, Women are less likely to go to cash. They're less likely to emotionally trade. They're more likely to diversify. Like, I mean, they do everything better. Like when you
Mhm.
look at, sort of behavior around that. I think it's a common misconception that women and men have dramatically different risk tolerance preferences. That's not the case
Okay.
in the research. But one of the things that we do see is that women and men have a confidence gap. So men are worse at managing money, but more confident about their ability to manage money. Women have better skills, but less confidence.
Wow.
But what's interesting is younger women, so like, women in their early 20s, say, have the same level of confidence now as men their same age. So that confidence gap with women is shrinking, I think, as society comes around to better ways of thinking, and as we start to socialize women as equals, and not the way that they've been socialized historically, which has sort of disenfranchised them from the
Mhm.
process. So yeah, risk tolerance is about the same. Women's investing chops tend to be better. And I think that you're seeing the confidence gap shrinking. So something to look out for.
Yeah, well, I mean, and so one of my, guiding missions and goals of this position, as a director of communications and as an advisor, somewhat of a unique position that we feel excited about, because we're trying to spread financial literacy. And even though you did mention that you can't have too much information sometimes within in investments and security selection, it is important, I guess, to educate yourself and become financially literate. Not That doesn't mean, oh, I don't want to be rich, I don't want to be powerful. I don't know. It just means become understanding finances that can best suit you for whatever your financial goals are. That doesn't mean be a millionaire or be a billionaire. Being financial literate can help you live a more have options in your life, flexibility, maybe tend to help you family members or health outcomes and whatnot. So something we're passionate about is spreading financial literacy, and it's something that you're clearly doing with your work. So I certainly appreciate you coming on. I think all of your work is amazing. I've been a follower for a while. I'll make sure to link everything in the comment section when I post this out of all your work. But thank you, Dr. Crosby, for coming on today, and I appreciate you, and hopefully you have a great rest of your year.
Yeah, my pleasure, man. Thanks for having me on.